Hi everyone, this is Mrs. V Chan. Welcome to my Form 6 Costs Accounting lesson number 7. So today we will do one DSE question in 2012, and which is question number 4. Alright, so here is the question number 4 in 2012. Okay, so we are given all this information, and then let's take a look here. So Magic Company adopts the marginal costing system. So this is very important because there are two costing systems. One is marginal costing system and one is absorption costing system. And what is the purpose for this marginal costing system? Which is for decision making, right? Okay, and now here assume it does not keep any inventory as at 31st October 2012. So this is 2012 October, so this is opening month to this 30th November, and then calculate the following for product X for the month ended 30th November 2012. That means the closing inventory in October will be opening in November. So since we don't have any closing in inventory in October, so there won't be any opening inventory in November. Alright, so A here, what is the thing that we have to calculate, which is the budgeted total value of closing inventory. So since this is marginal costing system to calculate closing inventory, so the variable costs will be included as product costs under marginal costing system. Now let's look at the question. Alright, so here point number 1, the budgeted production and budgeted sales for the month are 5,000 and 4,400 units. So that means you can see this is number of unit produced of 5,000, but we only sell 4,400. So what is the difference between this? So the difference between this 5,000 minus 4,400, so it will be the number of units for closing inventory. Alright, so 600. So I have closing inventory which is equal to 600 units. Okay, and next this is selling price, and the number 3 here we have direct material costs 40,000 per unit. Remember the cost behavior. To identify the cost behavior is very important. So what is cost behavior for direct material, which is a kind of variable costs? And then also we have this an additional transportation costs of $2 per unit to be incurred for the purchases of direct material. So this is same as this transportation cost, actually is same as the carriage inwards on purchases. Of course, this is also variable costs. Alright, because the more we purchase, the more transportation costs we have to pay. Alright, and then number 4, each unit of products requires 2 hours of direct labor, and the hourly rates of direct labor is this $60.5. Okay, so what do you think about direct labor? Also, it's a kind of variable costs. So that how do we calculate that? So that hourly rates is 60.5, and each unit we need 2 hours to complete that, so times 2. Okay, so 60.5, so I have 60.5 times 2. Alright, so $121 will be the direct labor hour per unit. So this is also variable costs. Okay, and then next, point number 5. Okay, and this is a special point in this question about point number 5. So you can highlight this point number 5. Okay, and saying that the production overheads of the product comprise a fixed and variable element. So what do you think about the cost behavior of this production overheads? When there are both fixed and variable elements, that means it is a kind of mixed costs. Okay, alright, so next, it is the company's policy to apportion variable production overheads in relation to the number of units produced. Now we are given this information. Alright, so what is it? So saying that monthly fixed production overheads of the company remain the same in 2012, the annual budgeted production overheads will be this much if we produce 58,000. Now we can set equation related to this production overheads. Since it is mixed means part. So this is related to 5 parts, fixed costs plus variable costs. Here, if we produce 58,000 number of units, okay, and the total production overheads in this situation will be 1,159,000. Okay, so I said this is equation 1. All right, and then I have fixed cost, which is unknown, and then another unknown variable cost. So therefore, I need to set another equation, and then we are given the information like this. Okay, so this is a total production overhead. If we produce this 66,000 number of units, so that I put total production overhead here. Okay, and this is my equation 2, and fixed cost is always the same, plus variable cost per unit. Now if we produce 66,000 here. Okay, now I have 2 simultaneous equations to solve fixed costs and variable costs per unit. Alright, so to find these 2 unknowns, so I need to do elimination. Let's say I have equation 2 minus equation 1 to eliminate the fixed cost, so that will be 66,000 variable costs, yes, minus 58,000. So that therefore I have this 8,000 variable cost is equal to equation 2 minus equation 1. Okay, so I get on the right hand side of the equation 44,000. Therefore, variable cost will be this much divided by 8,000. So 5.5 per unit. Okay, now I have this variable cost 5.5 per units. Okay, all right, so to find fixed cost, let's say I substitute this into equation 1. So in equation 1 I have FC plus variable costs. Oh, sorry, now I can do substitution, right, because I already get this variable costs, so which is 5.5 and then times 58,000 equals to 1,159,000. Okay, so to find fixed costs, so I have this 1,159,000, yes, minus 5.5 times 58,000. So here is 84,000 is the answer for fixed costs. Okay, but something very, very important is about the time. So we are given all this information is for a year. All right, so therefore this 840,000 is for 1 year. Okay, so point 6, we have selling and distribution expenses consist of sales commission. So sales commission is also a kind of variable costs, but however, since it is not related to production of the inventory, so that it won't be included as the calculation of closing inventory here. All right, and a fixed monthly distribution expense of 50,000. So what do you think about this, which is given? And that is fixed cost. Now, after analysis, we can go to part A. So to calculate the budget to total value of closing inventories. All right, so here I have a nice heading statement showing the budget to total value of closing inventory. So we have all the variable costs, so direct material costs. Okay, go back to the information. Point number 3, direct material costs, which is $40 per unit. So I have 40. All right, and here, so variable costs, transportation cost $2 per unit, also a kind of variable cost. So I have $2 for transportation costs. So next, direct labor is also a kind of variable cost, so which is 1 to 1. Okay, and what else is variable from part 5? So we have the workings here. Variable cost per unit is 5.5, so I put 5.5. All right, so altogether, so 42 plus 1 to 1 plus 5.5. Okay, so therefore this is 168.5 per units. for variable product cost under marginal costing system. Okay, so to remind you one more time, so under marginal costing system, so only variable costs will be included as product costs, so that we work out this 168.5 as the product cost per unit, okay, which is only variable. Now, times closing inventory, number of closing inventory. So from point number 1, we get closing inventory, which is 600 units, so times 600, so we get this total value of closing inventory under marginal costing system. Okay, all right, so this is about part A. Now we go to part B. To calculate budgeted total amount of contribution. So what is the formula of contribution? So total contribution is equal to contribution per unit times quantity sold, right? Remember this formula from the previous lesson. So that how do we calculate contribution per unit, and which is equal to selling price per unit minus variable costs per unit. So this is the formula to calculate contribution. All right. Okay, next I have a nice statement showing part B. The heading is statement showing the budgeted total amounts of contribution. So to work out contribution per unit, the formula is equal to selling price per unit minus all the variable costs per unit. All right, so here variable product cost per unit, actually we have worked out that from here. All right, so that the variable product cost per unit, so I can put this 168.5. Okay, so now selling price per unit, go back to the question, point number 2, expected selling price 300 per unit. So I start with this 300 minus variable product cost per unit. Okay, what else is variable? So point number 6, I have this sales commission $8 per unit, which is variable costs, so minus 8. Alright, so therefore that would be 300 minus 168.5 minus 8. So this is contribution per unit, which is equal to selling price per unit minus all the variable costs per unit. Alright, now here to enlarge it to total contribution, so that we need to times number of units sold. So this is important, it should be units sold, alright, to work out contribution instead of unit produced. So what is the unit sold here? Which is 4,400. So times 4,400, so times 4,400, total contribution is equal to 54,340. So that is part B. Alright, now we come to part C to calculate total amounts of net profit under marginal costing system. Alright, and also something very important, we are doing this net profit which is for a month. So what's left under marginal costing system after we have worked out contribution, which is fixed costs? So here I have a nice statement showing total amount of net profit, and just now I made a careless mistake for this unit sold. It should be 4,400 number of units, so therefore total contribution it should be 543,400. So therefore to continue with this total contribution, we have this 543,400. Okay, so what's left in the profit and loss treated as period cost? So that will be fixed cost only. So here we minus fixed cost, but something very important. So fixed production overheads, we have solved this 840,000, the simultaneous equation just now, and also remember that this is for 1 year. However, we are doing this total net profit for a month, so this is very, very important. Don't forget to work out that in 1 month. Alright, so finally, what else is fixed? So here, point number 6, we have this 50,000 for distribution expense, which is fixed and for 1 month. Alright, so therefore, how much will be net profit under marginal costing? So 543,400 minus fixed production overhead for a month, and then minus 50,000. Okay, so this is the final answer for net profit under marginal costing system. Right, okay, so that's it for this DSE question in 2012. So thanks for watching and see you next time. Bye bye.